Top 25 KYC interview questions and answers. Know your customer KYC is a critical process in the financial and banking sectors designed to verify customer identity, assess potential risks, and ensure compliance with anti-money laundering AML regulations. KYC professionals play a vital role in protecting institutions from fraud, corruption, and illegal financial activities. The following 25 KYC interview questions and detailed answers will help you prepare thoroughly and demonstrate your expertise in this essential compliance field. 1. What is KYC and why is it important? KYC, or Know Your Customer, is a regulatory process used by financial institutions to verify customer identity before offering services. It helps prevent fraud, money laundering, and terrorist financing. KYC ensures that businesses understand their clients' backgrounds, financial activities, and potential risks. The process involves collecting and verifying identity documents, address proofs, and financial details. Ultimately, KYC maintains financial transparency and ensures compliance with international and local anti-money laundering AML and counterterrorism financing CTF regulations. 2. What are the main components of the KYC process? The KYC process includes three main components: Customer Identification Program, CIP, Customer Due Diligence, CDD, and Enhanced Due Diligence, EDD. CIP focuses on collecting customer information like name, date of birth, and identification documents. CDD verifies this information and assesses risk levels. EDD is applied to high-risk clients, requiring deeper background checks and continuous monitoring. Together, these stages help financial institutions identify, verify, and monitor customers to prevent fraudulent or suspicious financial activities. 3. What is Customer Due Diligence, CDD? Customer Due Diligence, CDD, is the process of verifying a customer's identity and evaluating potential risks associated with them. It involves collecting key information such as identification documents, proof of address, and business details. Financial institutions perform CDD to ensure customers are legitimate and not involved in illicit activities. CDD is applied to all clients during onboarding and is reviewed periodically to detect unusual behavior or changes that could indicate potential financial crime risks. 4. What is Enhanced Due Diligence, EDD, and when is it required? Enhanced Due Diligence, EDD, is an advanced verification process used for customers classified as high risk, such as politically exposed persons, PEPs, large corporations, or clients from high-risk countries. EDD includes gathering more in-depth information, reviewing source of funds, transaction monitoring, and regular updates. It ensures transparency and mitigates potential financial crime risks. EDD is critical for maintaining compliance with AML regulations and preventing financial institutions from being exploited for money laundering or terrorism financing. 5. What documents are required for KYC verification? KYC verification typically requires identity proof, address proof, and financial information. Common documents include passports, national ID cards, driver's licenses, and utility bills. For businesses, incorporation certificates, tax identification numbers, and beneficial ownership details are essential. These documents are verified for authenticity, validity, and consistency. Digital KYC systems may use biometric verification and AI tools to confirm identities efficiently while ensuring compliance with data privacy and AML regulations. 6. What is the role of KYC in AML compliance? KYC forms the foundation of anti-money laundering AML compliance. It ensures that financial institutions know their customers and understand the nature of their financial activities. By verifying customer identity and assessing risk, KYC helps detect and prevent suspicious transactions. Regular monitoring and due diligence reduce exposure to illicit activities like money laundering or terrorist financing. Therefore, effective KYC implementation is essential to uphold global AML standards and maintain institutional integrity. 7. What is the difference between KYC and AML? KYC, Know Your Customer, is a subset of AML, anti-money laundering. KYC focuses on identifying and verifying the identity of customers to assess their legitimacy. AML encompasses broader regulations and practices aimed at preventing, detecting, and reporting money laundering and financial crimes. In short, KYC is one of the first steps within AML compliance frameworks, ensuring institutions know who they're dealing with before enabling transactions or providing financial services. 8. What is a politically exposed person, PEP? A politically exposed person, PEP, is an individual who holds a prominent public position or has close associations with such individuals, such as politicians, judges, or military officials. Due to their influence, PEPs are considered high-risk clients, as they may be more susceptible to bribery, corruption, or money laundering. Financial institutions apply enhanced due diligence, EDD, to PEPs, requiring deeper investigation into their background, sources of wealth, and financial activities. 9. What are red flags in KYC monitoring? Red flags are warning signs that indicate potential financial crime or suspicious activity. Common red flags include inconsistent customer information, large cash transactions, frequent offshore transfers, use of shell companies, and unexplained wealth. Other indicators include reluctance to provide documentation or transactions inconsistent with the customer's profile. Identifying red flags allows compliance teams to investigate further and report suspicious activity through Suspicious Activity Reports, SARs, or equivalent mechanisms. 10. How do you conduct ongoing monitoring in KYC? Ongoing monitoring involves continuously reviewing customer transactions and profiles to detect suspicious behavior or changes in risk levels. This includes analyzing transaction patterns, verifying data updates, and rescreening customers against sanctions or watch lists. Automated monitoring systems and AI tools assist in detecting anomalies. Regular reviews ensure that customer risk ratings remain accurate and regulatory compliance is maintained. Effective ongoing monitoring strengthens the institution's defense against money laundering and fraud. 11. What is a Suspicious Activity Report, SAR? A Suspicious Activity Report, SAR, is a document submitted to financial authorities when a financial institution detects transactions that appear suspicious or potentially linked to criminal activities. SARs contain details of the transaction, customer information, and reasons for suspicion. They play a key role in AML compliance, enabling regulators to investigate and prevent illicit activities. Filing SARs promptly and accurately is essential for maintaining regulatory trust and institutional integrity. 12. What is meant by risk-based approach in KYC? The risk-based approach in KYC means tailoring customer verification and monitoring procedures according to the level of risk each customer presents. Low-risk customers undergo standard due diligence, while high-risk ones, such as PEPs or clients from sanctioned countries, require enhanced due diligence. This approach optimizes compliance resources by focusing efforts on higher-risk cases, improving efficiency, and ensuring regulatory compliance without overburdening the KYC process with unnecessary checks. 13. How does technology improve KYC compliance? Technology enhances KYC compliance through automation, artificial intelligence, and data analytics. Digital identity verification tools, biometric scanning, and machine learning models streamline onboarding, detect document fraud, and identify suspicious patterns. Automated systems also enable real-time sanction screening and transaction monitoring. These innovations reduce manual errors, improve efficiency, and ensure compliance with global AML standards. Overall, technology allows financial institutions to maintain accuracy, scalability, and faster KYC verification processes. 14. What are sanctions and watch lists in KYC? Sanctions and watch lists are government or international databases listing individuals, entities, and countries involved in illegal activities or subject to trade restrictions. Examples include OFAC, UNEU, and FATF lists. During KYC checks, financial institutions screen customers against these lists to prevent dealings with restricted entities. If a match occurs, the institution must halt transactions, conduct enhanced due diligence, and possibly report to relevant authorities for further investigation. 15. How do you verify beneficial ownership in corporate KYC? Beneficial ownership verification involves identifying individuals who ultimately own or control a company, even if ownership is indirect. Institutions review corporate documents, shareholder structures, and ownership percentages. Regulatory standards often require disclosure of anyone owning 25% or more of a business. Verification prevents misuse of shell companies for money laundering or tax evasion. Accurate identification ensures transparency, accountability, and compliance with global AML and counterterrorism financing regulations. 16. What challenges do KYC analysts face? KYC analysts often face challenges such as incomplete customer data, evolving regulatory requirements, high volumes of documentation, and time constraints. Additionally, global clients introduce complexities like differing ID formats, language barriers, and varying AML laws. Detecting fraud in digital environments also poses difficulties. Overcoming these challenges requires strong analytical skills, technological support, regulatory awareness, and collaboration among compliance teams to maintain accuracy and meet stringent KYC standards efficiently. 17. What is remediation in KYC? KYC remediation refers to the process of reviewing and updating existing customer records to ensure compliance with current regulatory standards. It involves identifying outdated or missing information, re-verifying documents, and reassessing customer risk profiles. Remediation is crucial after regulatory changes, audits, or internal reviews. Regular remediation ensures that all client data remains accurate, reducing compliance risks and maintaining the institution's reputation and adherence to AML and KYC obligations. 18. What are the penalties for non-compliance with KYC regulations? Non-compliance with KYC regulations can lead to severe consequences, including hefty fines, regulatory sanctions, license suspension, and reputational damage. Institutions may also face criminal liability if negligence results in money laundering or terrorist financing. Regulators like FATF, OFAC, or local authorities impose strict penalties to enforce compliance. Beyond financial losses, non-compliance undermines customer trust and could lead to loss of business partnerships or market credibility. 19. How is digital KYC different from traditional KYC? Digital KYC, eKYC, utilizes online verification methods such as biometrics, facial recognition, and document scanning to authenticate customer identities remotely. Traditional KYC, on the other hand, involves physical submission of documents and in-person verification. Digital KYC improves efficiency, reduces paperwork, and accelerates onboarding. It also supports global compliance through secure, automated systems. However, digital KYC requires robust cybersecurity and data privacy measures to protect sensitive customer information. 20. How do KYC analysts assess customer risk levels? KYC analysts assess risk levels by analyzing customer profiles, transaction patterns, geographic locations, and business activities. Factors like occupation, source of funds, and political exposure influence risk categorization. Customers are classified as low, medium, or high risk, and each category determines the intensity of due diligence required. Continuous monitoring helps update these risk ratings over time. Proper risk assessment ensures regulatory compliance and minimizes exposure to financial crime. 21. What is periodic review in KYC? Periodic review in KYC involves regularly reevaluating customer profiles and documentation to ensure ongoing compliance. Depending on risk level, reviews may occur annually, biannually, or at specific intervals. During the review, analysts verify whether customer details or risk profiles have changed. It ensures outdated information is updated and any suspicious activity is detected early. Periodic reviews maintain data accuracy and uphold AML and KYC standards effectively. 22. What is transaction monitoring in KYC? Transaction monitoring is a continuous analysis of financial transactions to identify unusual or suspicious patterns. Systems use rules, threshold, and AI algorithms to detect anomalies like large transfers, cross-border activity, or inconsistent spending behaviors. Alerts are reviewed by compliance teams, and suspicious transactions may trigger SAR filings. Effective transaction monitoring helps prevent money laundering, ensures AML compliance, and provides valuable insights into customer behavior over time. 23. What is the difference between onboarding KYC and periodic KYC? Onboarding KYC occurs when a customer first opens an account or begins a relationship with a financial institution. It involves collecting and verifying identity documents and assessing risk. Periodic KYC, however, is conducted at regular intervals to ensure information remains accurate and compliant. While onboarding establishes the initial risk profile, periodic KYC updates are based on ongoing activities, changes in circumstances, or evolving regulatory requirements. 24. How do you handle a high-risk customer? Handling high-risk customers requires implementing enhanced due diligence, EDD. This includes obtaining additional identification documents, verifying sources of funds, performing detailed background checks, and conducting more frequent monitoring. Institutions must also document all actions taken and justify risk decisions. Ongoing reviews and close collaboration with compliance teams ensure such clients remain compliant. Maintaining transparency and vigilance prevents regulatory breaches and minimizes institutional exposure to potential financial crimes. 25. How do you stay updated on KYC and AML regulations? KYC professionals stay updated through regular training, regulatory publications, and compliance workshops. Following updates from organizations like FATF, OFAC, and local financial authorities is essential. Subscribing to compliance newsletters, attending webinars, and participating in certification programs like CAMS, Certified Anti-Money Laundering Specialist, ensures continuous learning. Staying informed enables professionals to adapt policies and procedures to evolving regulations, ensuring full compliance and organizational integrity. That KYC professionals are vital in maintaining financial transparency, safeguarding institutions from illicit activities, and ensuring adherence to global compliance standards. By mastering KYC fundamentals, due diligence processes, and risk assessment techniques, candidates can excel in interviews and real-world compliance roles. Staying informed about evolving regulations and technological advancements ensures continued success in this dynamic and essential field of financial integrity and customer verification.